bond yields neither predict nor depict the consumer price index. Rather, they quite accurately forecast and realistically reflect inflation. Interesting. It sounds very esoteric. It sounds like a paradox. We're going to unpack that statement with the help of the man that wrote it, Jeff Snider, the head of global research for Alhambra Partners. Jeff, we're going to do a two-part special. Part one, we're going to be focusing on the 1950s bond markets and inflation in the United States. And then in part two, we're going to move to the 1960s, 1970s, and more recent years, 2000s, and try to, I guess, what will be the Aesop's fable, the life lesson out of these two episodes, Jeff? How would you summarize it?
Well, we're trying to get at the CPI depicts consumer prices, and we're really trying to figure out what is behind an increase or lack of increase in consumer prices. And I think, again, inflation is an emotional topic for very good reasons, which we've talked about, because it's the most painful thing, and it's something that you notice every time you go to the grocery store when it happens. Yet what we're trying to do is say, this is different from this. The CPI goes up under certain circumstances for certain reasons, and those reasons are something else. And then there are other times when the CPI goes up for reasons, and then it tends to stay up for reasons that are monetary in nature. And so we're trying to figure out, can we sort out between consumer price increases that are due to money, therefore inflation, or some other consumer price increases that are due to other factors, which would make them transitory or temporary? Because as we all know, real inflation, which is sustained consumer price increases, is always and everywhere monetary phenomena. So if there isn't the money system behind it, there isn't the money growth and money overgrowth, whatever you want to call it, behind the consumer price increases, it's not really inflation. So we're not really saying that consumer prices didn't go up. We're trying to tell you that, okay, maybe they went up for other reasons, and that in identifying other reasons, that will help you understand what's actually happening and what we can do about it. Because, and so, what we're really trying to do is, okay, as we're sorting through the CPI, we're trying to make sense of, is there some tools out there that we can lean on to help us discern which one is which is consumer price increases for non-economic factors, which is consumer price increases for monetary factors, and is there a way we can tell the difference?
As we approach our workbench, we see several tools lying there. One of them is labeled Bloomberg, the other one is CNBC, third one's financial media, and then there's a fourth one that says U.S. sovereign bond market. And that one's very shiny, but it's also been put to use for decades, for generations. It's a tool that's welcome, useful, helpful, and is, how would we describe it? It's a Swiss Army knife. What's that one tool that you can always count on and use? I don't know, Jeff, but whatever that tool is, that's what we're going to be saying the bond market is. We're going to start out with an essay that you wrote at the Real Clear Markets blog site, and it was called "The Federal Reserve's Policy Deficit Has Always Been About Money," posted on the 29th of October, 2021. We're going to go all the way back to 1950, the U.S. economy, and you inform us that in the first 6 months of 1950, the U.S. economy was rip-roaring. Why was it rip-roaring? It was rebounding.
It was rebounding from a really nasty recession in 1949. Plus, there are all sorts of positive contributions from, general secular factors, the world recovering from the aftermath of the Great Depression and World War II. So there are positive factors there as well. Plus the initial surge out of the recessionary trough, especially first half of the 1950s. So the economy was already expanding in, double-digit rates. I think GDP was growing at, better than 12% in both quarters. So it was actual legitimate economic recovery at that time in the first half of 1950.
That's right. So from November 1948 to October 1949, we are told that there was a recession. It was an 11-month recession. Unemployment reached 7.9%, and the peak to trough decline in gross domestic product was 1.7%. Doesn't sound like a lot, but let's not forget, of course, we're not just measuring what actually took place, but what was missing. We're anticipating growth. So we didn't get the growth that we should have been getting for those 11 months. Plus, there was an actual decline. And to your point, In the first quarter, GDP grew 16.6% at an annual rate. And then the second quarter, 12.8%. Unbelievable, huge. But you draw to our attention that consumer spending was not powering this rebound. And you draw our attention to something else. Why?
Well, because first of all, I think the point that you just made about the business cycle is a good one, is that, in the initial recovery period, it's not just that we start growing again. There's that catch up, right? We had this period, and it was an entire year where growth was missing. Not only was, the economy in contraction, but we missed out on a lot of growth. And so a real recovery usually starts out with, okay, we're starting to go back in the right direction, but also we have to catch up we have to make up for this year that we lost in terms of lost growth. So there's businesses that reinvest, there's inventory that needs to be restocked, there's all sorts of those types of catch-up processes that begin the recovery trend, that are more focused on getting the economy moving back in the right direction, that isn't necessarily due to consumers who kind of come in later when things are really starting to go well. Because remember, businesses are just starting to rehire, they're just starting to reinvest and do all these other recovery type processes.
That's right. You note that over half of the first quarter's increase in GDP was due to just businesses restocking. That's going to be very important because in this third quarter, what we saw was consumer spending surging, a wild frenzy to purchase goods, which should sound familiar for modern viewers. But Jeff, it wasn't the coronavirus that convinced consumers they needed to buy goods now, immediately, and stock them away. It was something else, something that happened in late June 1950.
You wouldn't imagine it, but in the second, as you said, the third quarter of 1950, consumer spending was at such a pace that it put what's gone on this year to shame. It was such an enormous wave of consumer, whatever kind of word you might want to use, frenzy,
Binge.
something. Binge, yeah. It's just consumers just went nuts, but they had a legitimate reason, and that's kind of where we're getting to here. On June 24th of 1950, it doesn't sound like these two events would be connected, but the North Koreans invaded South Korea and therefore triggered the Korean conflict. Now, how does that lead to American consumers going completely crazy? Well, remember, 1950 was only half a decade away from World War II, and consumers, in their living, very vivid memories, understood what national war and conflagration actually meant in terms of the economy. It meant rationing. It meant hardship. It meant you had to buy stuff while it was available. And so as soon as those first shots were fired in Korea, Americans realized what was coming. If the United States was going to join the Korean conflict, which looked very likely from the very beginning, they knew eventually the federal government under Truman was going to start rationing and cracking down and cutting back on what was available in terms for consumers to buy and use. So they quite naturally bought everything they possibly could, knowing that at some point in the not too distant future, those goods that were available in the third quarter of 1950 would not be available very widely going forward during the war.
It's hard to believe today, 21 years into the 21st century, but governments would ration during war, at least back then. And not very long after the invasion by North Korea, in September, the United States Congress passed something called the Defense Production Act, September 1950. And what was that? That basically gave the government a lot of control over price controls and wage controls and production and governing.
Industry in general. The government could come in and say, look, we need you to build this for us because this is a war and national survival is at stake. So you used to make cars, General Motors, now you're going to make tanks, whether you like it or not. And again, people accepted that. In World War II, it's easy to accept that kind of government control given the nature of the struggle at hand. Even though Korea wasn't the same level of national struggle as World War II had been, consumers rightly understood what Truman was going to do because that's in very short. The president was very honest in saying, look, this is what we're going to do. The Defense Production Act was essentially the sort of the anticlimactic part of that process, which was we're going to start taking over certain parts of the industrial economy because we got to manufacture things for the war.
Here's the description: an act to establish a system of priorities and allocations for materials and facilities, authorize the requisitioning thereof, provide financial assistance for expansion of productive capacity and supply, provide for price and wage stabilization, provide for the settlement of labor disputes, strengthen controls over credit, and by these measures facilitate the production of goods and services necessary for the national security, and this is my favorite part, comma, and for other purposes. Ladies and gentlemen, you will not be surprised that that was passed in September 1950. The Korean War was over-ish a few years later, right? 3 years later, if I remember. All right, people will say, well, the Cold War continued. Yeah, that was over in 91. Jeff Snider, I'll give you 3 guesses, and the first 2 don't count, as to whether or not this act is still on the books to this very day and is being used by each president, and the last use of it was by President Biden because of fires in the West, in the United States. It's unbelievable that such a thing never sunset, but maybe that's just me. Let's get back to the economics. So this was...
From the nature of government to the nature of economics, right? Those things are sometimes intertwined, but it's amazing, or not amazing, but standard procedure that, governments, power, all of that stuff would flow through an economic system, and usually at the expense of people, folks, and consumers.
So the United States consumer was correct. They anticipated that they needed to buy like crazy because all of a sudden the goods may not be available. Goods shortage sounds familiar. And over the next couple of quarters, you note that there's this alternating between consumer spending surging, pulling back, inventory surging, pulling back. It sounds familiar. It sounds like chaos. And then where do we go from there? I guess you segue to prices. Tell us what is happening to prices. You have some dates here: June 1950, July, went from a negative to a positive. Tell us what was happening to prices.
As you would expect in the 1940s type of a recession, there had been outright deflation in consumer prices throughout 1949 that extended into 1950. Now, consumer prices were already rebounding in the first half of 1950, as we said. The recovery starting to manifest, and there was consumer prices going back up, a little bit of reflation in that respect. But in July of 1950, all of a sudden, consumer prices just absolutely surged. And again, they did so in a way that makes the consumer prices of this year look tiny by comparison. So the CPI turned positive in July 1950 on an annual basis, but it truly accelerated from, I think it was July 1950 until February 1951, which was, an 8-month period where consumer prices were rising at I think it was 12 or 13% annual rate, which is, puts 5% annual rates to shame.
Exactly. And we can see why. But the question is, was it due to
consumer demand, restricted supply, small e economics, simple supply demand curves that show us that prices have to adjust, right? If people are willing to buy a whole lot of goods that aren't really widely available, they're going to bid for them. They're going to pay whatever they have to, especially if you believe that I have to buy this good today, or I may not get it for many years down the road because it's going to be denied to me. It's, again, it's the same exact mechanics as we have in 2021, only this time at an even bigger scale.
Now we're going to talk about what the bond market reaction was to this. Spoiler alert, or lack thereof. But erudite, smart listeners to this show will say, well, of course there was much of a reaction because there was this whole 1950, 1951 Federal Reserve, U.S. Treasury. U.S. Treasury was controlling the Fed, so there were caps on yields and all that sort of stuff. Tell us about, before we talk about bond prices, just set the scene. What was the Federal Reserve thinking when they were seeing these consumer price increases? What was the Treasury? What was the relationship between these two entities?
Well, going back to 1942 and World War II, the Treasury Department had said, hey, we're fighting a war. We don't want the government to be disrupted in financing this war. So your job, Fed, because you screwed up the Great Depression so bad, we're just going to give you a little job to make sure the bond market doesn't blow up. So you cap long-term interest rates implicitly, and you cap short-term Treasury bill rates explicitly, and therefore, we'll let you keep yourself in business, but you do what we say, which is your primary focus, Federal Reserve, is to make sure there's enough cash flowing through the system so that the government doesn't have a busted auction because we're fighting a war here. And so we fast forward to 1950, we got the Korean conflict, and the Treasury Department under a guy named Snider with a Y, not an I, and President Truman expected, hey, this relationship that began in World War II with the Federal Reserve is the same. Treasury is the top dog here. The Federal Reserve is an afterthought. Your job, Fed, is nothing more than make sure that the government can sell its debt because we have to fund this war. In the Federal Reserve over there, they were saying, well, wait a minute, we can do more here. We think we're pretty smart people. We understand the way things are going. And by the way, we see consumer prices creeping up. We're getting really concerned that this is going to turn into an inflationary nightmare on top of trying to fight the war. So maybe we need to reprioritize monetary policy so that instead of we make sure the Treasury can sell its bonds, maybe we let interest rates move around a little bit and prioritize instead consumer prices, because they seem to be getting out of control here. And maybe this is a good time for the Fed to assert its own independence, because for the good of the nation, we think we know what we're doing.
Now, the war and the wars, there was an intermission between the two. And I'm thinking of the years 1947, 1948, because what you just described with respect to the Fed and inflation and consumer prices surging, this wasn't the first time this had happened in recent years. Can you tell us a little bit about what happened in 1947, 1948, how, again, we thought there was going to be inflation and the Fed should do something, and then within a year, they said, well, never mind.
It's actually 1950 was actually the third time.
Uh-huh.
And the first time was 1936, when the Fed got all concerned about inflation during the Great Depression and said, we're going to raise the reserve requirement, which resulted in a depression within the depression in 1937. So strike one on the Fed and its inflation fighting capabilities there. As you just mentioned, Emil, 1947, 1948, again, consumer prices absolutely surge. And this time it was, again, a supply shock, because European nations started to buy lots of goods as they recovered from the ashes of World War II. The Fed said, oh my God, this is inflation. We better start buying long-term treasuries because the treasury market's going to fall apart. It's going to blow up. And then within, I think it was 8 months, they started to sell those bonds back because treasury yields didn't rise. In fact, we headed into a deflationary recession in 48 and 49, as we just said. So inflation panic in 47, strike two. No, this time is for sure 1950. No, we're absolutely positive. This time the treasury market will blow up, or at least the inflation, if we don't do anything, inflation is going to get out of control. We're absolutely serious this time. We're so serious that during the second half of 1950, as the Korean conflict is getting underway, the Federal Reserve created a scandal by publicly opposing Treasury's policy and creating an enormous amount of difficulty that hit the newspapers worldwide, because they said, this is our line in the sand. We are willing to risk this fiasco, this political problem, because we believe inflation is really getting out of control. Have you seen the CPI lately? And they decided, this is it. We're going to resist being placed under Treasury's control, because we think it's important to get control over this inflationary eruption.
In about a decade or so, Milton Friedman would say inflation is always a monetary phenomenon. And here we have a couple of examples of the Fed saying inflation is a consumer price phenomenon that will persist and be pervasive. What we're observing, these supply shocks, demand surges. Okay, so two examples. Here's our third one. And I've got the numbers here, Jeff, but basically what happened is consumer prices were going up, okay. Bond yields started to rise a little bit. They went up from 2.19, the deflation-induced low, you call it, to 2.4% in March 1951, and eventually by the end of 1952, 2.75%. Not really.
Yeah.
I don't know. What was...
So from the recession low in 49 is 2.19%, to by the time of March 1951, which is an important date. March 1951 is the month that the Federal Reserve actually achieved its independence from the Treasury Department. And it's a huge date in the history of the Fed. According to the Fed, they tell you this all the time, because they said we had to become independent of the Treasury because this inflation problem was so bad. And the bond market was, as this 12% annualized rate of CPI during that 8-month period was raging throughout the economy, the bond market was like, The long-term treasury yield, they didn't have a 5 or 10-year specific maturity back then. They just kind of called it the long-term bond yield. The long-term bond yield went from 2.19 equivalent to 240. So it was a 30 basis point rise or so over 12% annualized consumer price index increases. So the bond market was saying, yeah, consumer prices are going up by a lot, but we don't think it's going to last. Again, long-term bonds are looking at the long-term outlook. And as Irving Fisher noted over a century ago, long-term bond yields are a combination of growth and inflation expectations. So the long-term bond market was saying, okay, yes, we see consumer prices rapidly rising, rampantly rising. For an 8-month period is a pretty long period for that to go on, but then still saying, we don't think it's going to last very long because as a long-term bond yield looking forward and growth and inflation expectations, we don't see consumer prices to continue to rise at nearly the same pace. So that's why the long-term yield only rose a couple basis points during that the outbreak of consumer price increases in late 1950 and early 1951. In fact, long-term bond yields rose a little bit more after that was over than it did during the period it was in. And even then, the long-term yield only got up to about 270, which is not a huge move to go from 219 to 270. That's pretty much nothing. So what bonds were saying is long-term growth and inflation, yes, consumer prices are rising rampantly and rapidly, but we don't see it as inflation. We don't think this is inflation. It didn't matter at the same time. The Federal Reserve was going through all sorts of crazy, ridiculous schemes to try to remove itself from the Treasury. It did not matter that the Fed was saying, we're worried. We're so worried about inflation that we're willing to risk a political upheaval, a financial upheaval during the Korean War because we're so concerned about inflation. Bonds were just like, you guys are wrong. You have it all completely wrong. And guess what happened? Spoiler alert here. March of 1951 was the first month for the consumer price index to begin normalizing. So as soon as the Fed achieved its independence, that inflation suddenly disappeared. And it wasn't because the Fed achieved its independence. It was because, as Bond said, this was a temporary bout of small e economics, consumers going nuts buying goods that they knew they weren't going to be able to buy for a very in short order, and that it wouldn't last because it was not a monetary outbreak that would cause consumer prices to rise in a sustained fashion.
So that's right. So for an 8-month period, we had annualized rates of inflation of over 12% that resulted in all this political upheaval. But then by the end of 1952, CPI, did I say inflation? I didn't mean to say it that way. Consumer prices rose by 12% annualized rate.
It's ingrained in your head. It's pounded in your head, that's part of our, part of what we're trying to do here is to get, people to understand that not all CPIs are the same.
CPI by the end of 1952 was averaging or had come down to 0.75%. And by June 1953, it was half that at 0.37%. So the bond market was right, proven right. The Fed was proven wrong. Jeff, any summary thoughts? I think you summarized it well there. We're going to move on to the 1960s, 70s, and early 2000s next. Any final thoughts?
I think it's interesting. The modern Fed was born in March of 1951, seeing inflation that wasn't inflation, was created by an inflation scare in which the Fed scared itself that there was inflation, when at the very same time, all they had to do was look at the bond market and say, oh, there isn't actually inflation.
And that was the third time too, Jeff.
Yeah, strike three at that point. And then, of course, the real decade where we actually did get monetary inflation. I hate that term, but one of the worst bouts of sustained inflation in economic history. And where the hell was the Fed then? So the fact that the Fed screwed up in the pre-1950 era, strike three on inflation scares, didn't get the actual inflation right, that's really how the Federal Reserve operates throughout its history. It's not some omniscient, omnipresent, technocratic ideal. The Federal Reserve's history is torturous. They get everything wrong all the time.